What's up? This is Ryan with Planet Cheapskate. So how does an ARM loan work? In this video, we're going to be talking all about adjustable rate mortgages, or ARMs as they are called in the industry. We will be discussing what are the differences between ARMs and fixed home loans, what are all the details and numbers when it comes to adjustable rates, and what are the circumstances you would look for to get into an ARM loan product for your home loan financing. Now, when you hear most everyone in the mortgage industry speak of ARMs nowadays, what they are actually referring to is hybrid ARMs, not the annual variable rate, interest-only ARMs, or the mortgage meltdown-inducing option ARMs of the past. So just to clarify, in this video, whenever I am referring to ARMs or adjustable rate mortgages, it's the ARMs of the hybrid nature. So now, before we begin, I have to say, be sure to stick around for a very valuable ARM loan hack that will set you up on an even better path than a low fixed rate if a situation and circumstances are just right. But first, I'd just like to take a very brief moment to personally invite you to subscribe and join our community. I do a home loan rate update every Friday going into the weekend, along with a new video every Thursday, helping you manage through the world of credit, investing, real estate, and home loans. And also, when you do subscribe, be sure to hit that little bell and it will alert you whenever I release fresh content. Now, with all that out of the way, let's dive right in. So you're trying to decide which loan you should get. If you're unsure, try checking out my super quick video here that breaks down each of the 4 main fixed loan types in under 2 minutes. And then you can compare each of those options to this video with an adjustable rate mortgage to see which is right for you. An ARM home loan is a great option in certain unique situations where specific personal and economical situations are present. The most important detail is going to be that these types of loans are more beneficial to you as the borrower in a historically speaking high or medium level interest rate environment. That doesn't mean those are the only times this home loan should be considered, just that those moments are the times that this loan product will be optimally utilized to reduce your risk. You see, with a fixed mortgage rate, the future market risk of the fluctuating rates is squarely on the lender, while with an adjustable rate mortgage, the risk is primarily on your shoulders to bear. Now, why would anyone want to take on this risk? Well, typically the lenders give huge mortgage rate discounts to those borrowers who take on this risk. And as we'll learn later in my loan hack, there is a way to, even in any economy, to benefit from taking on this risk. Before we get into that, let's take a closer look at ARMs and how they differ from fixed loan products. ARMs, or adjustable rate mortgages, are available to VA, FHA, and conventional borrowers, and the pre-qualification and pre-approval process and specifications are the exact same as the fixed loan products for these mortgages. If you are wondering about those, check out this playlist here and it will guide you through all of that. So to compare and contrast the fixed and adjustable rate mortgages, one only needs to look at things in the simplest of detail. On a fixed mortgage, if you close on your home and sign your mortgage that you will pay a mortgage interest rate of 3% for 30 years, that means you will pay 3% on the outstanding balance of your loan from day 1 to day 10,950. In comparison, on a hybrid ARM, you will still have a 30-year term or life of the loan, but it differs in the fact that you will only have a short period where your interest rate is fixed, typically 3, 5, 7, or 10 years. Then after that, your rate will adjust, typically every 6 months, or now less frequently every year. So I'm going to be diving deeper to several critical details regarding the hybrid ARM home loans, and by the end of this video you will know exactly what you need to know about these types of loans. So chances are, when you are looking into an ARM loan or you eventually get the details, you're going to see numbers that look like this. Well, let's break this down to human comprehension. You see, this first number here, that represents the amount of time your interest rate will be fixed for. So in this case, it'll be fixed for 5 years. So between all these numbers, they like to use these little slash marks here. They're just to divide the numbers so you don't get even more confused. So you see the second number here? This number tells you how often your rate will adjust after the initial fixed rate period. You used to see mostly a 1 here, which meant the rate adjusts every year after the fixed rate period. Since the middle of 2020, you now mostly see a 6, which means the rate adjusts every 6 months. So why the difference? You see, the rate adjustment is based on 2 factors. First, you have the margin, and then you have the index. The margin is a fixed rate that is often between 2 and 2.75. This margin rate is fixed and does not change during the term of the loan. The second part is the part that adjusts, and it's called the index. It is based on the LIBOR, which is the acronym for the London Interbank Offer Rate, or the SOFR, which is the acronym for the Secured Overnight Financing Rate. In 2020, we've seen the industry move away from the LIBOR and begin using the SOFR, as Fannie Mae and Freddie Mac, the quasi-government entities that purchase loans, said they will no longer purchase LIBOR-indexed ARMs. So why do the LIBOR ARMs adjust every year while the SOFR ARMs adjust every 6 months? The LIBOR was an index that was making forward-looking projections based on limited past submissions by banks. This index relied on a rolling 12-month average. The SOFR, by contrast, is a compounded average of a rolling 30 days of risk-free transactions that were actually backed by U.S. Treasuries. In short, it's a quicker and better gauge of the risk-free borrowing rate. The switch from annual to semi-annual rate adjustments did come with one added protection by way of tighter rate caps, which we will cover next. So no doubt if you dug in anyway into ARMs at all, you've also seen this string of numbers and slashes and thought once again, what the hell is with all these numbers? So let me explain. This number here is the initial rate adjustment cap. This is the maximum percent your adjusted rate is allowed to raise after the initial fixed period. Then you got another one of the slashes, and this next number here is the periodic or subsequent rate cap. This number represents the maximum percent your adjusted rate is allowed to be raised per adjustment period. Then another slash, and this final number here represents the maximum or lifetime adjustment cap, and it is the maximum amount your adjusted rate cap is allowed to raise to. So when it comes to hybrid ARMs, when is the best time or circumstance to use them? And for that answer, we have to take a journey back to when these products were first popularized. So in the 1980s, lending rates were all over the place, with consumers sometimes paying as much as 20% on their mortgage, or on the flip side, borrowers paying 8, 9, or 10% for funds that cost the bank 15% to borrow. In this erratic and volatile market period seen the emergence of ARMs, as it was found that the least amount of risk across the board during highly volatile markets was found in loans with the shortest terms. But because most consumers could not afford a 5-year or 10-year home loan, the 30-year adjustable rate mortgage became a popular option. And because the borrower was taking on a bit of the rate risk, they could be rewarded with a bit lower initial rate, making this loan product a win-win at the time. Now flash forward to today's lending environment, and there aren't too many circumstances I would recommend an ARM other than the loan hack I discuss next. But for the benefit of future generations and market environments, you're going to want to look for a market that has borrowing rates at the top or at least middle of historic levels, because an ARM is sort of like a gamble you're making that the rate is going to go down rather than up. And if you're wrong, well, at least you have your rate caps to protect you. So as promised, an amazing loan hack that'll help you build equity quicker using an ARM product. So the circumstances to make this loan hack ideal is that you're going to want to either sell or refinance the home in under 5 years. So this is ideal for a flip situation or a first-time home buyer or someone who is okay with refinancing after 5 years. So this is going to allow you to roll more equity into a better home or save a tremendous amount on interest. So the hack is that you will get a 5-6 or a 5-1 hybrid ARM, which will give you the best rate. On the caps, you will want to try to get a 2-1-5, which is ideal for this product. However, if you go with a 5-1, the best you're probably going to be able to get is a 2-2-5. So the benefit to this loan product is you will likely save up to 1.5% on your initial mortgage rate for the first 5 years. This savings will allow you to pay more towards your equity and build your principal faster during the time you own the home. But the greatest benefit will be in the interest rate saved over the course of 5 years. Now allow me to demonstrate. If you have a $250,000 loan that you get a 30-year fixed loan at 4%, which isn't too bad of a rate relatively speaking, over the course of 5 years you will have paid $23,882 towards principal and a whopping $47,731 towards interest. Now on the contrary, if you got a 5/1 ARM at 2.5, which is just 1.5% under the 4%, over the course of 5 years, you will have paid $29,812 towards principal and $29,455 towards interest. So not only do you pay $5,930 more towards principal, almost $6,000 more in equity whenever you go to sell or refinance, but you've also saved a huge amount in interest between the two loan products by going the 5/1 ARM route. You save $18,276 in interest over the 5-year span. That's a huge savings and a great way to hack the ARM. So there you have it, everything you need to know about the hybrid ARM home loans, along with an amazing ARM loan hack that'll help you build equity faster and pay less in interest over a 5-year period. Please leave a comment below if I missed anything or you have a question. I'd love to hear from you. And listen, if you gained value or knowledge from this video, do me a huge favor and smash that like button so more people just like you can see this info. And if you liked this video, I'd like to invite you to watch one of my other videos. Over here, I walk you through the complete home buying process step by step. And over here, YouTube has determined that you may enjoy this video. Thank you for tuning in. Until next time, best of luck.